Happy Wednesday. Welcome to another week of the Educated Homebuyer Live with Josh and myself, and updating you on the economy, helping you, guide you through the real estate and mortgage world, and ultimately answering your questions here. Josh, happy Wednesday.
Jeb, I like how the
Hump
music
day.
ends. It's hump day, but I like how the music ends. It sounds very dramatic. It sounds like you're going to say something really important and
Profound.
presidential and profound. So it just sets us up. It sets the tone for the show.
Trump demands lower interest rates immediately.
Oh,
What do you
by the
think
way,
about that, Josh? What do you think
well,
about Trump demanding lower rates?
I don't think we already know what Josh thinks. I think presidents get too much credit when things are good, too much blame when things go bad, and people think they can do a lot more than they can. So he has the biggest microphone. Let's say that.
He has the the best microphone ever.
The best. It's the greatest.
No, in all reality, guys, thank you guys for being here. For many of you guys, you know how the show works. We typically do 5 o'clock. Tonight, we're starting at 4:30 because a lot of you guys last week said you liked the earlier time frame. So we're testing it out to see how it works. There's 70 or so people on at the moment, so seems to be working pretty well. But start putting your questions in the chat. We like to start the show off by going over some charts, by going over data, what's happening in the economy, with real estate, with mortgage, just overall in general. And then we start feeding into those questions. So the earlier those questions are in there, the sooner that we can get to them when we come out and really get the show kind of moving forward. But with that, Josh, I'm gonna
Well, hold on,
yeah.
Jeb, before you go, I don't want to get off the Trump subject because everyone loves talking politics. So we're going to talk politics for a second.
Oh boy.
I was eating lunch and reading the Wall Street Journal, and I came to a conclusion that if the first Trump administration, the face of the resistance was the New York Times or MSNBC, and they were always telling you how evil Trump was and that he was going to cause the end of the universe.
Yep.
The Wall Street Journal, it is like whatever article they write, they then put it into ChatGPT with a frame this as poorly as possible for Trump. Like they put extraneous information in every article that just reminds you he did this off the wall thing or this bad thing. And you're like, you realize that has nothing to do with this article. So I'm not taking a position. I'm just telling you it's hard to read an article when it's on one thing and they find a way to spin it that he is the devil. And when those other channels have kind of gone back to being more moderate.
Yeah, the news media is not what it used to be. So you should come to YouTube and listen to us. How's that? Good selling point, Josh. Let's get off politics here for a moment, or for the rest of the show, rather.
And let's talk about the government. We can talk about Powell and the press
and talk about inventory. Inventory at the moment, 26.5% more homes on the market this time than last year. We're still growing. Not at the rate that you would like to see, but I think we added about 4,000 homes nationwide, getting us up to 637,000 single-family homes that are unsold on the market at this time. So most years inventory bottoms in February and climbs through the spring. So we haven't bottomed quite yet, or we don't know if we bottomed, right? We haven't gotten through February, so it'll be interesting to see when that bottom actually occurs. But demand is weaker, and a lot of that has to do with 7% mortgage rates, which in turn could allow inventory to grow in an untypical way, or a non-traditional way, rather than when comparing it to other years. So weekly inventory went from 632,000 homes to 636,000 homes. Our peak last year was at 739. The expectation this year from a lot of people out there that have models and aren't just guessing and what have you, is they think the inventory is going to be somewhere in the low nines at the peak this year. So that'll be 170,000 or so more than where we were last year at the peak. Doing that math, that's about 20% or so higher than last year at the peak. So we will see what that actually looks like. But here in Orange County, inventory, Orange County, more or less flat. 2,781 homes. We were down 0.4% week over week. Huntington Beach actually saw an increase, but again, almost flat. I think we had 2 homes added over that period of time, sitting at 1.07% week over week. Now, something important to note, that doesn't mean just 2 homes were added. there were homes added, but they went under contract or something, they went active under contract or what have you. So we are getting more homes than you're seeing in some of these cases, but because things go into contract, it doesn't actually reflect in the inventory numbers because we're only looking at what's active out there in the market. This is new supply. So these are new listings actually coming to the market. 51,000 new listings this week. The trend, in total, 4% more sellers than last year, 13% more new listings unsold than in 2024 this week. So that could be a positive thing for the market for inventory because it's going to give buyers more choices. And if there's more inventory and things aren't selling, then you're going to see more price cuts. You're going to see sellers have to do things in order to get property sold. That takes us into asking prices are trending lower versus 2024. So there wasn't really a lot on this chart other than the chart itself. I thought, just an interesting chart to take a look at, just showing where asking prices are versus where they were last year. A little bit lower, but you can see when comparing it, it's pretty much in line. I mean, it's not crazy. It's a nice headline, but in all reality, when you're looking at the graph, it doesn't really reflect much at the moment. Home sales are underperforming last year. So total home sales contracts pending at the moment, 52,000 newly pending contracts versus 56,000 last year, 266,000 total homes in contract versus 276 last year. So yes, we have less. Interest rates were better last year, right? Affordability is improved last year. All of those things, allow the market to sell more homes at the end of the day. And so if we do continue to see more or lower rates throughout the year, then you're going to see home sales pick up, and we're going to likely be over that 4 million mark, which is essentially where we've been sitting the last 2 years. So price cuts, essentially it says it's not optimistic. The trend is not optimistic, but we're sitting, I think, at 32.6%. So 33% of single family homes have taken some sort of price cut. And we know just based on that line, that's pretty normal for just a general market overall. So there's always price cuts in every single need to be, but a lot of it will depend on what happens going forward.
The last 4, 5, 6 weeks, Jeb, Mike has had a really negative comment on this. And I look at this, when I look at these charts in general, I want to see, is the current line out of line from what we've seen previous years? So that, like, if you look at that 2022 line, it took a sharp tick up.
Yep.
But everything else in here, it's pretty similar shaped from year to year. So when I'm looking for something, do we have an inflection point? Do we have a change? Is something different?
The slope down isn't as steep as it's been in other January coming into February, right? It's more of a, you can't call that flat by any means, but it's not, the same leg down, so to speak. So we'll have to watch it. It's one of those things that we continue to watch and just see how it plays out. So, 60% of the homes on the market, Josh, was it 60% were built more than
60%, more than 35 years old.
Yeah. So my house is more than 35 years old. I think most in our market, I would say that probably 90% of the homes in our markets are over 35 years old.
Absolutely. Because at one point, my neighborhood was one of the newer neighborhoods in Huntington, and we were built in 72. So we were on 53 years now. And, that's common. And those of you in the Northeast are chuckling. Mine was born in 1852.
But why is this important?
Really, just from the standpoint of, we have Jeb's favorite recent word is bifurcation, this bifurcated market where the part of the market that is healthiest is new home sales, because the builders are able to subsidize and buy down those interest rates. So a lot of people looking at this decision, am I buying an existing home or am I buying a new home? That existing home, if it was built in 2000, even at that point, you're getting to 25 years old. At about 20, my house in 2003, Jeb, and it was built in 72. So at 31 years, you're like, well, this is dated. It needs some work. So both from a functional standpoint, it might need a new roof. The existing stock is aging and is going to need some updating and maintenance. And, I have a client, Jeb, this week that was out looking. She sent me over 3 properties. I looked at them, I go, this is amazing. All 3 of these look exactly the same. And I pull all of them up, and all 3 of them were bought by a flipper. And they were nice. They were high-end flips. All of these were over $1 million. But you're seeing seeing a lot of that because a lot of people don't have the ability to acquire the home and then do a $150,000 renovation to it. So there are a lot of people in the market doing high-end renovations to sort of update this stock to what people are expecting in the modern day.
No, good stuff.
This one here, Jeb, is the one that we get here on the show. Questions all the time. Oh my God, insurance going through the roof, or people going to be selling their houses. This is where you're actually seeing non-renewals. I had a cancellation notice this week, and he's in Woodland Hills. They were evacuated during the fires. His house did not burn down. But with that, he's looking at some very expensive insurance. But for the most part here, Jeb, the parts of Northern California are seeing the biggest non-renewal. Florida are basically all along the Gulf Coast except for Texas, and then your homeland there of North Carolina.
Yeah, for sure. And it's hurricane, right? It's all natural disaster stuff is what's most of the stuff outside of Northern California, which, I mean, I guess a fire is a natural disaster to some extent. I mean, unless it was set. But yeah,
eco-terrorism.
Yeah, exactly. Check, Josh, you've frozen on me twice. I don't know if you're freezing anyone else. Let us know in the chat if you are, but just check your stuff over there and make sure don't have a lot open.
Perfect. Well, we're going to go to the optimistic part of the show here. This shows real national wealth per capita. So the wealth per person has been steadily increasing since 1880. So you, Jeb, myself may not feel that, but really per capita, per person in the U.S., wealthier than at any time in the history. Jeb, we're getting great notices here. Prince says we're both freezing. So our wonderful internet here is back.
Fantastic.
In action.
Fiber can't even control us, dude.
The flip side of it, Jeb, in addition to incomes being up, we hear a lot of people saying that home prices is too high. Home prices have to come down. They're too expensive. So this is housing worldwide, just showing affordability. In the U.S. is the one way over on the right that is the most affordable. It shows the expenses. So certain parts of the world, you really would not want to see how expensive it is. That's cold comfort to you if you're on the outside looking in, wanting to buy. But really, affordability isn't as bad here as it is globally, most anywhere around the globe. I was looking for Canada is much significantly more expensive, and they're in the middle of this chart. You said something last night, Jeb, on the seminar, and we were kind of going through this, that we talk about home prices having gone up 4.5%, almost 5% for the last 50 years in the U.S. Inflation for the last 25, 30 years has been at about 3%. So it is worth noting that over a very long time horizon, housing is expensive and has gotten more expensive. So I wouldn't look at the fact that it is expensive and affordability is at low levels as a reason why there's going to be some sort of technical reversal or that prices have to come down. Again, this one here, Jeb, I put it in just to say we need to be wary. The big news we all came into on Monday is that the Chinese had figured out AI, and for $6 with a pack of gum, they could make a better AI than the billions of dollars spent by Meta and OpenAI and all of these other companies, and that was going to cause our market to crash. There's a worry or a concern there that if you did have a big correction, which these are, what's CAPE, Jeb? It's the cap adjusted price earnings ratio. It's just showing that
you didn't even need me, bro.
I thought I was going to, so I called you. I tapped you in early. But Trump administration number 2 here is the most expensive per the cap ratio that stocks have ever been for an incoming president. So you can also happen to see, if we look at this, the ones further back were cheaper. So stocks have also gotten more expensive over time. So this could be absolutely nothing. Biden came in, he was number 2 on the list at the time. And over the last 4 years, we had a really strong and solid market there. So why do we talk about this in relation to housing? You have the wealth effect. When the stock market is doing well, people feel like they're doing well. I might only have $30,000 in the bank, but if my 401k went from $50,000 to $80,000, I might be more comfortable parting with that to buy my first home. So definitely all of those issues bear watching. Through this in here, just a quick one. The spreads are much lower than they were, 0.75% lower than they were about 2 years back, a year and a half back, but have kind of plateaued out at this level. We need to see rates move lower. And when rates move lower themselves, as measured by the 10-year, as measured by mortgage-backed securities, we're likely to see some further compression in those spreads back to what we talk about as being normal in the high 1s, low 2s would be even the high range of that. So, Jeb, we are starting to see a trend, a channel here. So, going back to September when we hit those lows, when everyone was refinancing, rates were great. We have not broken out of this channel. We tried it back in December, went back up to the top of the channel, and here we are at the bottom of that channel with those two aqua lines. So, we've come below to resistance levels or support levels on the top. Since this is the 10-year, we want to see this come down. We need to break out from under that blue line and then under the green line before we would really say there is a new downtrend in interest rates. Right now, it's going to need more data. The data this week, we get weekly jobless claims tomorrow, always important. We get GDP tomorrow. And then on top of that, Friday is PCE. PCE is the Fed's preferred measure of inflation. Probably going to come in about as expected, but best possible case, I think, for us right now is a little bit of a minor downside surprise, kind of like we got with CPI a few weeks ago. What does it mean in terms of interest rates? Pretty much flat from day to day, flat from week to week, flat over the month. And actually, as you pointed out in the open, Jeb, up about 0.2% year over year. And we're near the highs of that 52-week range. The low is 611, the high is 752. And at 7%, we're nearer the high than we are the low. So from that perspective, I can say people seem to have adjusted to this a little bit better. Like you were going through the notes. So I'm going to give anecdotal information here. Jeb, you have the charts there showing what it looks like. I can tell you for me personally, it's been a little bit more active. We have a few more people out looking at buying this year than the last couple of Januaries, which were much slower.
Yeah, I mean, I have buyers right now looking at property, going to show property again tomorrow morning. People actively looking. So yeah, there's definitely demand out there, but again, it's relative, right? So, what we're seeing doesn't necessarily transfer to all markets. Real estate's local. So just know what's happening in your market. Our market is still, doing fairly well, under 1.5 million, which is crazy when I say those numbers. Seems to move pretty well when it's priced correctly. If there's anything out there that's a quote unquote deal, the number of messages I get in a day between text, email, and phone calls of investors looking for quote unquote opportunities, you are going to be hard pressed as a buyer that doesn't have cash, doesn't have the resources to get these to ever compete on that level. Just because I can tell you just how many people are looking. It's kind of a pain in the ass, if I'm being honest, like the number of responses. Like, I try to pick up my phone as much as possible because you never know who's on the other line, right? It could be somebody looking to buy. So I try to always answer my phone, and I can't tell you how many of these are sales calls of people looking for stuff. So just know, that there's buyers out there and there's people looking in all price points. So just pay attention to your market.
Jeb, I just noticed something spectacular that we are on Fed Day and we've got 20 minutes in here and we didn't even talk about it. I didn't even put it.
Well, because it was
didn't
uneventful.
even put it in the slides. Everyone knew they were going to do nothing today. Yeah. They did nothing today. There was exactly one change and it led to about an hour's worth of interest in. They took one sentence out of their policy statement, which basically said it previously said that they see inflation moderating towards their 2% level, and they took that out. And so for a brief period, the market had a small panic and yields popped up a little bit. When they opened up the Q&A, someone asked him straight away, was that intentional? Do you believe inflation is about to take off again? And they said, absolutely unintentional, as hard as that is to believe. And the market went back to where it was. So I guess, Jeb, I have a couple of highlights here from either the press conference or the release that Powell said, we seem to be set up for further progress on inflation. The Fed needs to see progress on 12-month inflation, but he said they're seeing it. I don't think we need the labor market to cool off anymore, which basically flies in the face of what we've been seeing for the last year. They want to see the employment market cool off more, but they're saying they don't. Also said that we just chose to shorten the sentence on inflation. The sentence on inflation was not meant to send a signal. So that was where the market sort of recovered. And then the Fed is very much waiting to see what policies are enacted when talking about Trump and the new administration, and also saying they don't need to wait for 2% on inflation to cut rates. So as we continue to move in that direction, they are likely to continue to cut. Lots of talking heads trying to parse this out today, but we didn't really learn much, not super insightful, and the market basically didn't move because of that.
No, good stuff. So Josh and I did a home buyer seminar last night. Many of you guys know that if you were here last week. It was actually last night, about an hour and 10 minutes or so. Got through it. I know some of you guys were there. I've seen the comments in the chat. We appreciate the feedback. Thank you guys for being there. With that said, had a lot of people reach out from that. If you weren't there, you're trying to get through the process, pre-approval, you're looking to buy your first home. Maybe you're getting quotes from other people, just need a second opinion or have a conversation. There's a link scrolling the bottom of the screen, jebsmith.net/referral. We'll get you in touch with the team here. You can talk to Josh, go over your scenario. If you need a realtor referral, happy to do that. You can become a Jim and Cheryl, like we said last night. If you don't know what that means, we'll be doing another seminar here soon enough, and we'll put that information here. But in the meantime, you need to get in touch with us, jebsmith.net/referral. We'll get you that. And with that, Josh, let's answer some questions, shall we?
Let's do it.
Answer some questions. So start at the top. Start at the top of the show. Drew came in, says, "Good evening, gentlemen. I'm really curious about your recent video on USD mortgages. I know you did not have a number for money in the bank requirement, but do you have an idea?" So Josh, there's this idea out there with USDA that having too much money in the bank can hinder USDA actually lending you money. So I know you have guidelines there in your chat GPT. Can you pull that up and see if it gives a number, right? So doing 0%, my understanding is that, you can't have a ton of money in the bank. I've heard it's 25%. I've heard it's, different numbers. So let's see if Josh's chat actually does anything with guidelines.
Well, the funny thing is that set of the USDA guidelines were a little bit harder to find. So it's not my GPT is not trained on USDA yet. So we're gonna see how it does.
Well, let's see how it does, but we'll wait for a sec and see if we can get an answer for you.
We can circle back to it. They don't want to watch this GPT.
We'll circle back. So we'll come back to you, Drew. Question: a neighbor of my rental property built a shed less than the required amount of feet away, about 3 feet from our wall. He wants me to sign off on it. What should I be concerned with? I mean, I don't know. I mean, it's on his side of the wall, right? I mean, the problem is that case, like you have a roof. I'm assuming it has some sort of roof on it, which probably makes it closer to your wall in some regard. So I don't know. I mean, could water come off of it, come to your property, create puddles? I mean, there's not really anything there. I just, when you're not building by certain code, it just, sometimes it makes your property feel a little bit claustrophobic when things are too close. So Josh, do you have anything there that would be a concern? I mean, other than the obvious?
It's a shed. It's not a permanent structure. So let's also realize that some people, a shed is a little 4x4 thing that your neighbor built in the weekend. Others are these shed kits on Amazon that are 20 by 30 and could be, for all intent purposes, a garage and very similar to a permanent structure. So does it have a permanent foundation? Is it permanently affixed? Is it significantly large? And does it impact you? So for me, if someone builds something right on my line, property line with a big property, that's going to be a problem. But if I've got 4 acres and we're out in the woods, maybe I don't care. To me, it's more of a personal thing. If they didn't follow the setback guidelines and it's a significant structure and you're not happy with it, might be time to have a conversation.
Yeah. Sorry. I mean, not a lot of help there. It's just kind of, again, it's a personal preference more so than anything else. But I think the idea of a permanent foundation gives a little bit more guidance there. Josh, do we have anything?
So Jeb, this is going to be fantastic because we're gonna state this equivocally, not unequivocally. This was a document. So GPT, my custom GPT, did go out and find a link. So this is actual from a document. It's not it hallucinating. It says no down payment is typically required. Applicants are required to use assets in excess of the asset limits of $15,000 for non-elderly applicants and $20,000 for elderly applicants as a down payment. So we'll do some more research and confirm that, but that is from an FDIC document related to USDA loans.
So that's saying you can't have more than 20 grand?
If you have more than 20 grand, you're going to use it for a down payment.
Oh, okay. I know there's a rule. I couldn't find anything that was set in there, but I thought I would mention it that having too many assets could be a problem with the loan. Just make sure you're talking to a mortgage pro and having them research it for you.
And they do like under penalty of perjury. They have you list your assets, and you're going to sign an affidavit that says these are all the assets. So if I got $42 million sitting in the bank over here in an account with $12,000, I can't just show them the $12,000, Jeb.
All right, Dan, you guys wonder why I laugh. If you've been here week after
Stop
week,
laughing. Don't be a butthole, Jeb.
That I've tried to get Josh. He's got a sensor on his light. I tried to get him to take the sensor off. He refuses to do so. So he sets his light off every single time, and it pops on in the middle of the show. But he refuses to listen. And
hey, the best part is when I want the lights to come back on, I have to wave my arm vigorously.
No, he's making it up. He just wants you to empathize with his situation. All right. Dan says thoughts on a larger down payment: 30% versus 20% on $900,000 homes in the Bay Area. Advice, risk, benefits. Would still have a liquid emergency fund, 401ks, etc. Will be our first home. So Josh, when somebody's talking 20, 30%, you're getting essentially in most cases the best rate, pretty close to it, putting 20 to 30% down, assuming all your other parameters, meet the criteria, credit score, all that good stuff. You don't have mortgage insurance. So what is the bigger benefit at that point of putting an additional 10% down?
The additional 10%, nothing. 25% will get you better terms than 20%. 25 to 30 is a very, very minimal change. So if we're talking about just getting the best terms at 900,000, either way, anyway, we're going to be underneath the standard balance limits. So in the Bay Area, you have high balance loans. High balance loans are priced much worse than a standard balance loan. So from that perspective, that doesn't come into play because you're going to be under it either way. So really, from my perspective, I want to quantify what does it look like. We said here at the top of the show, interest rates are essentially 7% on a 30-year loan. $1,000 costs you $6.65 a month. So if we say the difference between 20 and 30 on a 900,000 purchase is $90,000. So what are we talking about? $598 a month. So how important is that $600 a month? And how important is the $90,000 in the bank? I more often have this conversation with a first-time buyer who's trying to make a decision between 3.5% and 5%, 3% and 5% down. So when we talk about a $5,000 difference with a $650 difference in the monthly payment, we're talking $30, $35. And they look at that and go, well, that's dumb. I'm going to do the lower down payment. In this situation, $600 is real money, but so is $90,000. So we have the fact that you don't get to have access to that money. If you need access to that money, you're going to have to borrow it either in the form of a second mortgage or refinancing, which comes with time, effort, expense. So how much do you value and need that liquidity? Sounds like you already have the reserves liquid elsewhere, so it's not that big of a deal. So then how much do you value the $600 savings? And is the $600 savings are essentially a guaranteed 7% rate of return? Is that more valuable to you than what you could do in investing that money? Those are the ways that I look at it, Jeb. And the thing that I always like to tell every borrower that we're talking to, it's not my question to answer. There's not a right answer. It's what feels right to you once you've considered all of those elements.
Good stuff. There's a couple follow-ups here that I wanna do because I think they make the questions that they ask more relevant and maybe change the answers a little bit. So Josh, Bill comes back and says, the shed is a decent size. Don't know if it catches fire and burns my house down. Will my insurance have a problem with it? Good question. That's something that in theory, their insurance would probably be responsible for your house, but your insurance company would be the one fighting it. But if you sign off on something like that, you're putting yourself probably at risk, especially in situations where insurance companies are always looking for a way out. So definitely something to consider. I would probably say no. I probably wouldn't sign off on it, and just in order to protect yourself. But that's just me. So
for me, I don't like it. And if you're saying that it's close enough to your house that it could light your house on fire and it's too close to your property line, I got a problem with it. What I would say is the time to address that is when you see it being built. And if it's a significant structure, I don't know. If I'm the neighbor, I'd be like, bro, you couldn't say anything while I'm building it.
Yeah, no, exactly. So, but again, it's one of those things. Maybe you can get away with not signing off on it. You're okay with it, and they can still have it. And something happens, then they're responsible.
And he's saying it's a rental. He doesn't manage it himself, so he probably wasn't even aware of it. And that would be a good answer. Hey,
Yeah.
buddy, I would have loved to have told you while you were building it, but I haven't been here in 3 months, and I show up and you did something stupid like building a giant shed on my property line.
All right, let's go back to Drew's question earlier about the USDA thing. Just said for easy numbers, let's say somebody makes $100,000 applying for a USDA loan for a 250 mortgage. What is that magic number that's supposed to be in the book? Ranges are fine, answers, blah, blah, blah. So I think we got that answer, Josh. I kind of read the question here. So if there's anything that's different from that, Drew, we will follow up and let you know going forward. So I actually have a contact.
The best part, though, I was going to say, it was basically stepping on your answer there, is if we answered it wrong, apparently Jeb has a friend at the USDA that watches every episode and all videos, and we'll reach out and tell Jeb that is incorrect if we answer it wrong.
Last time she answered, she said, "Hey, great video," but there was one thing that was about the credit score. So she helped correct the credit score, basically saying like they didn't have a minimum. I think was what it was, and but nevertheless, so. We will we'll see if we can get you an answer. Anthony says, what DTI level do you start seeing problems, Josh? We are looking to upgrade homes to 22% DTI. Currently it's 12. All other debt is childcare. That's 8%. So Josh, I think
how about
going to be okay.
Answer? We have a clear and definite answer, and that is it is not 22%. It's not 28%. It's not 35%. I would say the vast majority of the people buying in the current market are somewhere between 38 and 45, with a significant number over 45%. And usually once we get above 45%, there's something going on. Non-qualifying income, meaning income that they know they're going to get, but we can't use, we can't document it, or they haven't received it long enough. But 22%, you're nowhere near it. And I always, when people say this DTI, a lot of times people will ask us, well, my DTI is 11%. I'm like, well, you're renting. How are you calculating that? And they just mean, what are my debts? What shows up on my credit report? My car loan, my student loan, 2 credit cards. That's what it is. So I'm assuming that with that 22%, you are including the new proposed housing payment. If we're not, and we're at 22 and we're going to add another 20% on it, and you're up at 41, 42% for well-qualified borrowers. So there's 2 separate things. Jeb, people always like to ask, they come in and go, how much can I afford? Brother, I got no idea how much you can afford. I can tell you how much you qualify for. Only your knowledge of your budget and your spending is going to tell you what you can afford. So we're really just looking, is it a problem for qualifying? Is it a problem for getting you approved? Anything under 45 for someone with a 680 or higher credit score is not going to be a problem. And if we're going FHA, drop that number to 640, probably not going to be a problem, up to a 45, 47, 50%. That is more to tell you that there's enough flexibility in the guidelines that they are giving you some leeway to determine what's appropriate for you and your budget and spending.
All right. And if you're just watching now, tuning in, and, just after 5 p.m. here Pacific Standard Time, when we're already 30 minutes into this, I know we're normally 5 p.m. Pacific Standard Time. We're trying some new times just to see how it works with the audience. We started a little bit early last week, had a big turnout. So we started about 4:30, or we started at 4:30 this week, just to see what the numbers look like. So let us know in the chat if you like the 4:30 start time, if you liked 5 better. Let us know. We're here for you guys. So if we can accommodate the majority of the people, then, people can always watch it on replay. But if you want your question answered, then you got to be able to show up. So take some time. Let us know in the chat. It would be helpful, and we would both appreciate you doing that. So Josh Willing's got a couple of questions here. One of them is about impounds. If they closed their loan at $80,000, 80% loan to value. They did escrows at that time, and they're wanting to see if they can call their lender now a couple months later and request to stop escrowing. And if so, how does that work?
I'm starting to worry that Willing has my phones tapped or is in my email box, because we actually have a listener to the show, husband and wife in the Houston area, that are buying right now, putting 20% down, and they ask this exact question. So their disclosures went out. They signed them impounding for taxes and insurance. Texas can be, is one of the areas where I might consider not impounding, just because they only pay their taxes once a year. So it can make refinancing a little bit more wonky than other states. But the question is fine. It is your option on the way in. So for these folks right now, if they say, hey, I don't want impounds, we can remove them. But we also talked about, they think maybe we'll give it a shot. if I give it a shot and we get 6 months into it and we don't want to have it impounded, can I ask the servicer to remove them? And the answer is yes. You just call up, go through it and say, hey, went through this and we just don't like it. We'd rather have it separate. They're going to look at your loan to value. They're going to look at your payment history. And if everything is in line, they will allow you to do that. And to that point, had a borrower just told me, and we're doing a refinance for them right now. They bought last July. He tells me 3 months into it, he goes, I didn't like how they were handling my impound account. I called him back and told him to send me the money. And sure enough, you can see the $10,000 deposit in his account from his taxes and insurance. So you definitely have that flexibility. The important thing is to keep your account in good standing. Don't miss payments. Don't give them any reason to say no if you were wanting to take the impounds away later on.
All right, another question. Same person just saying, can you purchase a home and a vacant lot that is next door to that property all together in one transaction? In this case, it's 2 different parcels. And just, is that a possibility, Josh, or does it all need to be in the same parcel?
They don't. It comes down to the loan type, the loan program, what you're doing, what you might want to do going forward. Because what you've probably heard far more common is someone say, hey, I've got this big parcel and I want to do a lot split. So my house is over here. I would rather have separate parcels. So generally the land has a much lower value. So going back to our gentleman here who just asked the question, 900,000, I put 20 or 30% down. If you can pay cash for one parcel and then finance the other parcel, I would rather have them separate. But it does come down to the type of loan you're doing and what is common in the area, the way it's titled, the way it's structured. The second piece of that, can I get a loan to build a second home on my land that already has a home on that parcel? Largely comes down to the zoning. Is it zoned for only single families? Is it zoned for multifamily? Do they allow an ADU? Is the structure that you're going to build required, meet the ADU guidelines? I've got a funny one. My mom owns a piece of land with a shop in Idaho, and she wanted to put an ADU on it. And she says, they won't let me build an ADU. And I said, well, Mom, that's an interesting question. You don't have a house on the lot. You just have the shop. So I said, maybe go back and ask them, what can I build and what are the requirements for building a home later where that house could be the ADU? And there are requirements. It could only be a certain size and then the house built. So she did it in reverse. She has an ADU that she's going to live in. And if she ever wants to build a bigger house on the property, you can do that. So those are the things you want to look in. What's the zoning? What's the acceptable uses? And talk to the planning and building department at your city.
All right. Always interesting here. I just started streaming this to LinkedIn because I thought, why not? I have an account. Why not? I think this might be the first comment off LinkedIn, if I'm being honest. Just
I don't
saying,
think I've ever
love your
seen one.
videos, and I've been watching since 2020. So has anyone in here been listening since 2020? That's what I want to know. Not necessarily in here, just on my videos in general. Have you been around for 5 years? So that makes you a very loyal viewer.
Jeb, Shandy said since probably 2020-ish. And I just saw the ish, and I thought you had found someone from LinkedIn to tell you were full of ish.
I mean, it doesn't take LinkedIn to tell me that. I mean, there could be people in this room that would tell us that. Us, I said, not just me, us, Josh.
Okay. I'm lumped in with the company I keep.
Yep. Richard Jewell says yes. 2021. The name I recommend, I remember on Alma. Not a lot of questions tonight, Josh. Are we starting earlier? We've blown through.
Well, Dan has some feedback for you. He says back in the office, unfortunately. 4:30 p.m. is a great start time for the commute home.
There we go. If you listen on your way home, that's good stuff. Dan also commented and said the webinar was great. So Dan, at the moment, is a true listener in the sense of the show here, and we appreciate that. So thank you for supporting us and allowing us to educate.
And for those of you that tuned in and watched, before I go home tonight, we will finish the survey because we want to hear what you guys thought, what you liked, what you didn't like, what was maybe missing that we could add to it. Because as Jeb said, we're going to do it again. We want to improve it. Just continue to iterate on it and bring the value that you guys want. So if you missed it and you wanted to be there, we are going to do it again, and hopefully it will be improved thanks to the guinea pigs that showed up last night.
Great question here, Josh. Something that is very important and needs to be known for anyone that has a VA loan. Have a VA loan, 2.875%. If I sell to a non-VA buyer, which you can do, you can do an assumption, right? An assumption to a non-VA buyer. which if you can do that, guys, it's a great opportunity to take advantage of a lower rate. The question is, will I regain my full eligibility, Josh?
The answer is a hard no. So a non-veteran borrower has no VA entitlement. So the only way that your entitlement gets restored for you to go on and buy and do something else is for them to substitute their entitlement. So again, non-veteran doesn't have the ability to do that. They can absolutely take on the loan and you can be relieved of liability on the loan, but your entitlement, as long as they have that loan, will remain encumbered and not get restored. So depending on where you're at, it could be or could not be a problem. There's secondary entitlement. You can have two VA loans, which most people are unaware of. But if you're in California, you bought $1 million home, 0 down, you probably don't have any bonus entitlement that we can use. So reach out. It may not be necessary. If you're in a part of the country where you can get a house for $350, $400, $450. I've had a few people move from the East Coast where they have a $300,000 VA mortgage and they're able to get very close to 0 down in $600,000, $700,000, $800,000 range here in California. But it's a semi-complex calculation. We would love to help you with it, but I don't think anyone else wants to listen to us do it here live.
No, good. Dixieland Production says they've been listening since 2019 when I first started the channel. So there you go. Can you beat that? So thank you for the support. I don't remember seeing your name around until recently, but that's maybe you just
may have
commenting.
changed the handle.
Maybe you've changed that. That's a possibility. All right. Let's see. Walter, I just did a video on this today, Josh.
On Walter Arriaga?
Not on Walter Arriaga, but on the question that Walter has, says, do you think buying down the interest rate is worth it? And also, how was the Clippers game? So I didn't do a video on the Clippers game, just so we're clear.
We are foolish. We forgot to take the camera.
Talk about that. Yeah, we'll talk about that. Interest rate. So buy downs. I talk about it. There's a video posted next week on my channel where I talk about the idea of buying down rates. I personally, at the moment, don't think it's a good idea. In that video, I'll elaborate. But at the moment, if you believe interest rates are going lower within the next, year to 2 years, you're not going to have enough time to recoup the cost that it's going to buy down that rate, right? In most cases. So, 1% of your loan balance gets you about 0.25% in rate. So on a $500,000 home, or loan rather, that's an $83 savings, 0.25% interest rate from 7% down to 6.75. That's a 60.2 month recoupment period. So let's just say 5 years. If you think there's an opportunity within that 5 years to refinance lower, which I do believe there will be, then you're essentially throwing good money after bad intentions, if you will. So that's my 2 cents on it. Josh, anything you want to add to that, or should they just
the only piece that I add to it is, again, it's not a decision for Josh or your loan officer to make. It's a decision for you to make. I agree with Jeb. If I'm making the decision, that's how I'm going to make. But if I talk to you and you go, you're crazy, rates are never going lower. If I buy it down to 6.5 today with 1.5, that's going to be the greatest rate I'm ever going to get. And after 62 months, it's money to the good. I'm not going to argue or debate that with you. It really comes down to what your feelings are of what rates are going to do over the next 3 to 5 years.
All right. That's good stuff. I'm going to go off. Well, first off, let's talk about the Clippers game. So that was the second part here. So Josh and I brought up the next morning. So Josh and I have all the cameras in the world. We have cameras in our pocket, right? Cell phones. We didn't take one picture together that we could have posted.
We even have a camera lunch pail we can take with us on field trips.
We've got what's that camera called, Josh? The
Osmo 3, the latest and greatest.
We have all these cameras. We took nothing. We were terrible. And the next day I'm like, Josh, we didn't document anything. The fact that we were even there. But that aside, the stadium is awesome. The arena is awesome. If you haven't checked it out, it's worth going to. I think a concert there would probably be just madness because of the sound system.
The sound is amazing.
It's crazy. So, but it was, and then the Clippers just dominated. I mean, which they rarely
that's not
do
saying
to
much.
anyone.
They were literally playing the Wizards, the worst team in the NBA. What we were most struck by was how bad the Wizards were. I sent some text to a couple of my buddies that we used to play in the Drew League together. I said, the Wizards could not win the Drew this year. That's how bad the Wizards are.
There you go. But changing subjects here. Richard, I just want to point this out. Not to pat myself on the back, but this is like the kind of stuff you want to hear when you create, when you're a quote unquote creator of videos here, content creator. Thanks for your videos and notes that I took. I bought a 4-2 in Poinciana, Florida in 2023. You are truly informative and the most important, not boring. My real estate agent was amazed with my knowledge. Good stuff. So that's one thing we talked about last night. Your job isn't to be the loan officer. It's not to be the real estate agent. It's to know the questions to ask so that you're getting the right feedback from your agent, from your mortgage professional. So yeah, I appreciate that feedback. It's always positive to hear that sort of thing. So helps us continue to push on. Let's see here. Josh, questions?
Well, here, this is just a comment, but again, be careful where you're getting your advice or information from online. So someone here in the comments, no, your buyer can't assume your current loan terms. 100% incorrect. If you have an FHA loan, anyone can assume it. If you have a VA loan, anyone, including non-veterans, can assume it. It wasn't the question he was asking,
right?
And it was the wrong answer for the question that this person thought was.
But let's point out something that no one talks about when they talk about, oh, you can go assume this person's loan because they have a VA loan, or oh, you can assume their FHA loan. Yeah, you can. That's all legit, and there's some adjustable rates that are assumable as well. But here's the thing: you have to have the difference in how much they owe on their mortgage versus what you're buying that property for, whatever the purchase price of that home is, in cash, to be able to pay them so that you can assume that loan. So if they bought this home in, say, the middle of the pandemic, and they bought it for $250,000, for example, there's a high likelihood that home's probably worth $400,000 today, just, where things have gone. And they have, say, a 2.5% rate. Well, guess what? They now have $150,000 in equity. So unless you have that 150 to be able to go assume that VA loan, you're not an eligible candidate to do that. Now, in some cases, you might be able to get a second, which I've seen, but you're still going to have money to come in with the down payment. It's not just I assume the loan and I get it for free and not having any sort of skin in the game. And there's a lot of people out there that believe that, hey, I'm just going to go take over their loan at their loan amount and I'm good. No, it doesn't work like that. You're going to need some equity, in order to make that happen. So just keep that in mind. Nobody talks about that because that's not the sexy part.
To double down on that, Jeb, I have a lot of friends that do a lot of VA loans around the country, and the successful VA assumptions, the vast majority of them are veterans or active duty PCSing around the country. So you get sent from Fort Lewis up in Seattle, or they do a joint base, McCord, Lewis, whatever the heck they call it, and you get sent down to South Carolina. Well, you owned and you sold your house and you would like to buy a house. And we got another veteran who's getting stationed somewhere else and is moving, but you had a bunch of equity that you're coming in with, and you'd love that 2.875 interest rate, and you put it down on the next one. So it really is a lot of veteran to veteran. They're able to substitute their entitlement, so your entitlement isn't tied up. I just don't hear a lot either way. I know they're out there and they're happening, but other than the headline, it makes people click it. It makes buyers click it because they want this, they want something. It's just exactly like Jeb said. It's not quite as easy as that in the real world.
There you go. SF Miners says there's some houses coming out right now in my area. I've been in the market for a while. Can definitely wait. Should I wait for March to July to buy, to snatch a house now? Asking for potential of options. So hard to say, right? I mean, what I would say is, it sounds like you're going to buy either way. My thing is the property that you're looking for on the market now? If it's not, then there's no, why buy something that you don't like? Don't force yourself to buy. In the case that the home is on the market now, what are you waiting for, right? Are you waiting for something to change with that price? Because the likelihood is, more competition's coming with the spring, assuming rates don't increase, which I don't see that happening. So let's just say status quo for the market, more inventory comes to the market, maybe some more choices out there. But we know that the majority of the appreciation happens between March and June or July of any given year. So there's a chance by waiting till June or July, you're paying a higher price for that property based off what happened the previous months leading to that, right? Because all comps are based off what's recently happened. Can't say that that's the case or not. You just got to know your market and know what to do. But, I bought at probably the worst time possible in 2023, November of 2023, where the spike in interest rates happened. And it all worked out, right? Why? Because I wasn't looking at the hype. I wasn't looking at, you know, worrying about prices, worrying about rates. It was more of like, hey, is this the right decision for me and the future? Is this the right house? And made the decision off that. And looking back on it, I'm really glad. I mean, because things were happening in my family at the moment with my wife and medical stuff. There was a really high probability there for a good week or two that I wasn't moving forward with that deal. And now I look back thinking, wow, I'm like, I can't believe everything lined up the way that it did and things worked out the way that it did. But I'm happy that I took the jump, because otherwise, at this point, looking back, I would have regretted it. So, not to say that's going to happen to you, but you just kind of got to look at where you are and look towards the future and make the decisions based off where you think you're going to be. And, that's it. So anyway,
Jay, we got a couple of interesting comments here. J-Dub co-signing that you are correct. I had to put 100,000 down for a 2.25 VA assumed loan. So congratulations, whether you have to come with 100,000 or not,
Yeah.
getting a 2.25 VA, and then follows up with non-VA, by the way. So I'm assuming he's saying not a veteran was able to get a VA loan. So 2.25, no mortgage insurance, because if you assume a 2.25 FHA, you've got 0.55 or 0.85 mortgage insurance attached to that. So smoking deal, was able to get in, had to come up with his own money, but having $100,000 bought him a great loan.
So, question for you, JW. Just why do you show up to a home buyer show when you already own a home? I'm appreciative that you're here. I'm grateful that you're here, but I always like to know why people do some of the things they do. And just some people just like to be in tune with the market, and that's
People with the
completely fine.
2.25 rate like to show up and brag, Jeb.
And that's fine too. Hey, listen, you're helping support what we just said, which again, we don't need that, but it just helps justify, in some cases, you want examples, and this is a perfect example of that. Burn It Up follows up. Hey, hello both. So they're talking to you, Josh. Most of the time it's just me that they're gloating over, but in this case, you're there as well. Long time, but glad I listened to you, even in the high desert in California. It's getting expensive, and I would not have been able to afford now. I think a lot of people are in that position. A lot of people that own their homes today would not be able to buy those homes today just from a couple of years ago, because so much has changed within a 2 to 3 year period. Again, not normal, but when you're trying to base things off what you think is going to happen, you can make irrational decisions in some case, and miss out on opportunities.
Not a whole lot of questions.
No, not a lot of questions here. So with that,
Jeb,
we'll probably wrap up tonight at 5:30 if no questions are coming.
The question about that VA was the current loan is $420,000 left on it, and in Maryland, so it's less important how much is left on it versus what the original loan amount was, because that's how much of your entitlement was used. But with only that much tied up, depending on what you're wanting to do with the new current loan limits, there is a good chance that you would not need. You might be able to do a 0 down or a very little down and get another home with your VA, which certainly would open up the world to potential buyers who would be willing to pay a premium for your home for that below market interest rate. So reach out if you want some help with that. We can definitely run the calculations for you and let you know what it would look like. And if it works, we can handle the VA financing for you in Maryland.
All right, there you go. JW followed up, just said, hey, watch many of the videos before, very informative, helpful. Even watched you guys explain about assumable loans a while back. So hopefully that was helpful and cleared anything up that you had, you're wondering about. So this is a good question.
I'm just happy that we got to hear someone that actually successfully did an assumption, because they are few and far between.
Yeah, I mean, I think they happen more often than we probably hear about, Josh. But because of how much equity has been gained, the majority of the buyers that we talk to don't have large down payments. We're not helping people buy multi-million-dollar homes. A lot of our people are first-time home buyers, and they don't have a ton of cash. So we're seeing it less on our side, but the opportunities are there. Walter has a question here that we address a lot, and I think it's something that we can touch on. Walter's 25, has about $30,000 saved. Credit's good. Lease is about to end in July, but doesn't know what to do. The mortgage payment will increase about $600 more than what they currently rent, asking what to do in this case. So Josh, we always again, this is not telling you to do something, to go buy a house, not telling you should rent. It's just, hey, listen, this is how you have to think about it. When you're renting, it's hard. It's really easy to compare where you are today, rent rent versus mortgage, right? And say it doesn't make sense because the mortgage is more expensive than the rent. What you have to do is look out to see where your rent's going to be in 5, 7, 10 years from now, right? In most cases, rents are increasing 3 to 5% a year. So, depending on what your rent is now, start doing the math, compound that over that period of time and just kind of see where you're going to be in 5 years. What's that rent going to look like in 5 years compared to what that mortgage is? The nice thing about buying a house sooner than later is you can fix that housing cost, the principal and interest part of it, more so than anything else. And you're 25 years old. So you have to realize that you're in the early stages of earning income, very early stages. You should continue to earn more income. So your wages should go up. You should be able to continue to save more money. And at some point, you're assuming you qualify, which you should be able to if you can qualify for a mortgage now, should be able to refinance and take advantage of a lower rate. So not only are you fixing your housing costs early in your life, but you're going to be able to probably lower the rate. And as you make more money, it's going to become less and less of your overall budget. But if you wait 10 years and do it, you're now 35. You're still not at your prime earning years, but you're further along than you would have been otherwise. And my guess is probably regret not doing it at that point. So doesn't mean you should go out and do that, but that's how you have to think. You can't think of, this is versus this now, because rarely ever are you going to be able to get a house where the payment is less than it is to rent. I know in some places of the country it might still be possible, but for the most part, it's not reasonable to think that.
We ran the numbers for an episode of the podcast about 12 or 18 months ago, and just showed that within 10 years, less if there is a refinance to, if we're at 7 to a say high 5s, low 5s, even more so, it makes it about 5 or 6 years. Rent is going to continue to appreciate. It appreciates at about the rate of inflation, slightly above that. Homes appreciate over the long haul at a higher rate than that. So anything can happen over a 1, 2, 3, 5-year period. So no one can guarantee you what's going to happen. But I'm willing to bet large sums that 10 years from now, renting is going to cost more than what your mortgage payment would be today, which will be lower because you're likely to have an opportunity to refinance it, along with the fact that you're going to be making more money over the long haul. People are amazed that if you look, the government puts out this data, the average house payment for an owner is far less, like not a little bit less, far less than for a renter. And you go, that's insane. No one can own for less than it costs to rent. Well, they can because they bought 10 years ago, 15 years ago, 20 years ago. So much lower mortgages because they're able to fix that cost, refinance when the opportunity comes. And you don't have that as a renter. It's going to continue going up 3 to 4 to 5% a year for indefinitely.
Yeah, a perfect example. When I bought my house in 2020, in 2012, the house that my wife and I first bought when we got married, the total mortgage payment, I forget what it was when we first moved in. We were paying about $2,500 in rent. And we went and bought that property. And if I remember correctly, principal, interest, taxes, insurance, everything was like $4,000 or so. At some point, we were able to refinance and take that $4,000 down to like $3,000. So we were all in that property for $3,000. At the time I sold that property, my mortgage payment was $3,000 with principal, interest, taxes, insurance, everything. And I could have rented it for probably $5,200 a month. So, I mean, just shows you, right? I mean, it wasn't $5,200 when I moved in, but because of appreciation of properties and, why didn't I keep it? Well, because what I was jumping to required, I wasn't comfortable with the payment on it. So I needed to sell it. I needed the equity to make that happen. So the long story short, looking back, do I wish I would have kept it knowing what rates would have done? There's some of that there, but at the end of the day, it's, I don't have regrets over that. So, but that's what you got to be thinking about. Josh, this is a good question. Depreciation, right? Not something we've really seen, but the question is a reasonable question saying, should depreciation be a concern in that the last couple of years haven't been normal? So we've been way above trend with appreciation. So if we say the last 65 years nationwide, we've averaged about 6.5% in appreciation. Last couple of years, we've seen 50+% in appreciation over, say, a 3-year period of time. Isn't it reasonable to think that you're going to give some of that back, or is that just, craziness, crazy talk?
Homes over the long haul have trended to less and less affordable. Does that mean that you can't get too far ahead of yourself and have trouble? No, it doesn't. But we've talked about a lot here. To see large scale mass depreciation, mass loss in prices, you have to have an economic downturn that results in a lot of people losing their homes, banks taking them back and liquidating them at any cost. So for us in Southern California, we've had three busts. There were two fairly large, the Great Recession, and then there was one in the late 80s, and then another in the mid 90s. And every one of those, you look back, and more than 40% of the homes in the multiple listing service were bank owned. What happens when you have a normal garden variety downturn where prices get ahead of itself? They can correct over the long haul by incomes coming up, by potentially rates coming down, and home prices going sideways. But when they're going sideways, they're actually correcting in real terms, meaning that if homes go up 1% a year and inflation is 3% a year, there was a 2% loss in value in real terms. And homeowners are willing to accept a loss in the real value of their home, but they don't in the inflation adjusted value, but not in real terms. So they're not going to sell. And it's not just at what they bought. I bought my house for $580. There's no world in which I will ever have to worry about selling my house for less than I paid for it. But the reality is, whatever I think it was at the peak, as a homeowner, that's the way homeowner brain works. That's what my home is worth. I'm not going to sell it for less unless I absolutely positively have to. So the things that we talk about, death, divorce, illness, massive loss of a job where you don't have an option. But when we're in the current market, where most everyone is sitting on very low interest rates, massive amounts of appreciation, and it, just like Jeb was saying, it's cheaper to own your home at the lower price that you bought it at with the lower interest rate, you're going to hold on to that thing for dear life. It doesn't mean that no one is going to lose their home. It means that not enough people are going to lose their home to have this massive correction in prices. So there will be a correction back sort of to that mean, but it's more likely to be in an extended period, 4, 5, 7, 10 years of below trend growth, unless we were to see a big drop in interest rates below what we're expecting now. If you get 2.5, 3.5, 4% interest rates, home prices,
and all bets off the window.
Yeah.
A couple comments here. Again, it's been a comment show, but there's been a lot of positive comments. So bought a house, I bought a second home after listening to the podcast, and it helped me a lot. Now I listen to keep up with the market. Maybe I can get a third with your knowledge. And then follows up, miscellaneous of the whatever, says, I am a homeowner and I am here because I don't know what I don't know. You guys are awesome. So appreciate that. It's very helpful to get feedback from you guys.
Jeb, we got more. We can keep going since there's no questions.
Yeah.
Dan just says, I had no idea about interest and property tax deductions for a long time when he was renting. So things that he's been able to get brought up to speed. And
David, something, honestly, with it, depending on what happens with the SALT tax, owning a house may have even more benefits here, depending on what happens with that, right? So some of that was eliminated with in 2017, and it may come back with a vengeance here, depending on what happens with the changes, if there's changes rather. So anyway.
Yep. No, and David here, just another one. Really want to put people up here and recognize you and thank all of you guys that have been here for so long. Yeah. So David bought during the COVID frenzy, so 3-4 years ago, and still here showing up and supporting the show. So we appreciate all of you.
Yeah, no, good stuff, guys. So again, we came on an hour early. None of you guys even commented earlier.
Half hour early.
A half hour early. Sorry, an hour early. 4:30. We came on at 4:30 versus 5 p.m. Pacific Standard Time. I know we tell everybody 5 p.m., but you guys seem to like this. But I asked a moment ago, and no one answered. Come on, people. You like the show.
There was one answer. The person who said that the commute time is a good time for them.
Yeah. So do you like the 4:30 start time, or do you like the 5 p.m. start time, or would you like something in between, 4:45? So all of it can be accommodated. Just need to know what you guys want so that we can do it. So 4:30 is perfect for miscellaneous of the whatever. Damn, we got a lot of people here that started giving comments. So appreciate all you guys. You guys rock.
Like 5 demand 5. So Trump is here demanding 5. He wants 5.
All right. Well, just listen. We got a couple more minutes here, Josh. I mean, we're I guess we got more than that if we wanted it, but let's just see here. That's not it. We've already clicked on that one. They're moving up too quickly. Here we go. Do you think there is a high probability that our insurance rates will skyrocket this year? Last year, I got a 300% increase. So, yeah, I think depending on where you're located, there's a high likelihood that you see an increase. Skyrocket, hard to say, right? Again, California is one of these states that put limits on these people and these insurance companies on how much they can increase premiums. That's why companies leave. Do other states do that? I don't know. I don't think so. So depending on where you're located, you're going to see, more, some more than others. But I do think overall, just based on what's happening, with natural disasters, with, fires and that sort of thing, that and how hard these companies have been hit, you're probably going to see some increases. So it's, but your guess is as good as mine. Josh, does the price change over time on the property tax bill? What is CDD? Are you familiar with CDD?
I do not know.
I do not know what CDD is. You can enlighten us in the chat. That would be helpful. We says started watching the channel in January of 2022, and thanks to you guys, I bought my first house 2 months later when rates were climbing up to 4%. Good on you. Good on you.
And that wasn't the easiest time to buy. Lots of people put it on pause and said, "Oh shit, I'm not doing anything." So good job for toughing it out and stepping in at what looks like a great rate today.
Yeah, and then we've got Heather saying she doesn't like the 4:30 because she gets off work at 5. Richard starts at 5. I think, Josh, if we start at 5, then the 4:30 person can accommodate. The 5 p.m. person gets their thing. Both get a portion of the show to some. So, we've built it around 5 o'clock because that's kind of the expectation, especially on the podcast. We talk about it all the time. Some of those people listen, they don't watch. So probably going to be somewhere around 5 o'clock going forward. If we can start early, maybe we'll start early. But we want to be able to give you guys, time to answer questions or ask questions so that we can answer them. And, we want some consistency so you guys know what to expect.
Jeb, a CDD is a community development district, and it sounds very similar to Melrose.
Yeah. So probably some sort of infrastructure tax that's added to the tax bill. That typically doesn't increase where we are. So what happens, just for those of you listening that don't understand what Melrose is, or I don't know if CDD is exactly the same, but when they build a new community, they need to put streets in, they need to put sewer systems in, they need to build schools and parks and so on and so forth. And in order to do that, what they do is they sell these bonds to pay for it. Well, guess who pays for those bonds? You do, as a homeowner, and you get to pay it for 25, 35 years, depending on how long that bond is. And you typically pay it in your property taxes. So every single, whenever you pay your property taxes, you're paying that tax bill. That part of it does not go up. At least my understanding is that it's kind of a set rate that stays the same. That's just one bond measure. Now you can get some other bonds in there, other things that affect your tax rate overall. But I don't think the Melrose itself should change because you're just paying off an amount that was allocated a long time ago, right? So that amount's not changing in most cases. So at least that's my understanding. Maybe I'm wrong. I don't know.
Since we don't have CDDs in California, don't take that one to the bank. Do your own research. Yeah,
exactly. And we can ask Chat GPT. Josh, ask your custom chat.
I need to get it experts on community. We need to get it really up to speed on insurance and then things like that. Property taxes, assessments.
Yeah,
this is good. You guys are giving us good information to feed.
No, insurance would be good. With. So with that, guys, I think this is going to be the end of tonight's episode. Check out the latest episode on the Educated Home Buyer podcast. We talk about the changes in the housing market, how that might be affecting you as a buyer or seller. Next week's, we're going to talk about Trump a little bit more, some of his policies, some of the craziness out there, how it's affecting the market, things that you absolutely need to pay attention to. So now that post Monday instead of Tuesdays, both on the podcast and here on this channel. If you need Josh or myself, you can get us using that referral link at the bottom, jebsmith.net/referral. Until next time, have a great night. Adios.
Amigos.